the entire world is staring at the Middle East, watching oil blast past $100 a barrel and hanging onto every single headline. We're seeing messages that the war could be over soon, and retail traders are treating this like a quick deep buying opportunity. But retail is walking blindly into a massive trap. They are treating a structural global crisis like a short term meme stock. Look at the USO ETF just shattered its all time daily volume and by a lot, with 7.6 billion traded by midday, completely dwarfing the 2020 and 2022 panics. And call volume on oil is at a 10-year high. Literally, every retail trader is longing oil right now, betting on de escalation. When a trade gets discredited, any headline hinting at a ceasefire or a deal will cause a violent mean reversion as this call liquidated, as we saw in the past few days. But here is the terrifying reality. The market is mispricing. Even if the hot war ends tomorrow, the global supply chain is now broken. This isn't a 2 to 4 weeks event. The Strait of Hormuz hasn't been hit by missile, but has been hit by an insurance blockade in a way. Even if the war is over tomorrow, ships are now blocked by the insurance requirement because no ships will want to cross without insurance. And even with the US potentially providing some of that insurance, it's going to have an impact for months or years to come as insurance have to reprice the model. Look at the physical market. In this 3 month calendar spread, we can see that the WTI had a premium exploded for immediate delivery. Basically, people are willing to pay a lot more to get the oil right now than in 3 months' time. And this is the kind of desperation we haven't seen since the 2022 invasion of Ukraine. And one of the reasons why we see this is because Asian countries are paying a massive premium right now to take over ships because otherwise their reserve will run out very quickly. You can also see on the next chart here that the US has some reserve, but the level is actually quite low. If you look back, the last time it was this low was in the 1980s. And so if the US and the other G7 countries do use their reserve to stabilize the oil market, if this war doesn't end soon, it could actually be even worse down the line because they will be empty when they will need it the most, basically. The whole thing goes far beyond oil because I think it is a global resource crisis. When you shut down the Middle East, you aren't just shutting down gasoline, you are also shutting down LNG to Taiwan, which threatens global semiconductor production, and shutting down natural gas, which is required for many things, including to create fertilizer. And so we could actually get a food crisis, both in some countries within the next few weeks, but also globally within the next few months. And so this is something that kind of a lot of big implications. Another one that we saw recently was the switch to targeting on both sides civilian infrastructure like the desalination plants, providing clean water, the power grid, and other things. So when survival is on the line, global trust evaporates, and nation will begin to hoard resources and potentially fight against each other to get a hold of it. And I think that's interesting as this graphic. There are a lot of parallels between the 1970s stagflation and inflation and what we have right now. Back then, there was also oil price going parabolic, a war escalation in the Middle East. The US economy was locked into a stagflationary phase. And in July 2008, there was a similar oil shock and inflationary spike that sent the CPI to 5.6, which was the straw that broke the camel's back right before the deflationary banking crash of the global financial crisis. So we are witnessing a generational rotation. The technology sector's weight in the SP 500 has peaked, in my opinion, as you can see on this chart. And basically, what we could be seeing is that just like in the dot-com bubble, tech fell from 35% to 15% in just 2 years. And that kicked off a decade-long bull market in hard asset. And I think we're about to start a new bull market for hard asset, potential like an energy super cycle. With this kind of level of war and inflation, you'd think gold would be printing a new all-time high, but instead we just saw a massive outflow, a 2.9 billion outflow from the GLD ETF. That was the largest in a decade. We don't really have the exact answer for this, but it is potentially a dollar squeeze, basically forcing nations to sell some of their gold to be able to get some USD back to pay for the increased price for oil. It's interesting to see that gold is not behaving at all like what we would expect in a global conflict, which is including about at least 20 countries. While the world is distracted by the Middle East, the US domestic economy is quietly imploding. We are rapidly approaching what could be like the Biden moment. Remember before the debate, everybody on the mainstream media was saying Biden is sharp as a tack. And then after the debate, no one could defend that narrative anymore. And so I think we are close to that point in regards to the US economy. The latest reading from the Atlanta Fed GDP Now, which was published today on March 10, is showing a massive drop from the more than 3% they printed last time to just 2.1%. I think the growing illusion is fading, and the labor market is also flashing major red warning signs that the Fed and the government won't be able to ignore much longer. The reading from last week was a 6 sigma miss. We're seeing a lot of 6 sigma miss. That's supposed to be a statistical anomaly. Basically, the official print came in as a negative, and it was expecting as a positive. It was minus 92,000 jobs. So that's really bad. And the household survey, which I think is much more accurate, came out minus 185,000 jobs. As usual, a recession is called like a year later when it's obvious to everyone. So you can't really wait for the official recession to be declared. The next chart, I think, is a good indication also of where we are. So basically, when the BLS revised the total job created for 2025, and it will be revised on again because December was overestimated, just like everything they did in the past few years. But as you can see, that level was basically right in the middle of the recession following the dot-com bubble crash. And this brings us to the most dangerous part of this video. Basically, Wall Street is doing another AIG, like in 2008, and I'll tell you why. And this is happening right under our nose in the $2 trillion private credit market. Here I'm putting a tweet I saw where someone pointed to a clip of a video that I watched as well. So in a nutshell, what AIG did in 2008 is that they basically were hiding toxic subprime mortgages onto their balance sheet, and they were not supposed to do it because it was supposed to be safe investment type for people who have annuities from insurance companies, like retirees, conservative investors, that kind of thing. And basically, over the last decade, giant alternative asset managers like Apollo and Blue Owl figured out a regulatory arbitrage. They went out and bought life insurance companies. And then they took Main Street money, so the conservative capital from people buying safe, stable annuities for their retirement, and they used it as permanent funding for the high-risk private equity tech loan. And then they domiciled these entities offshore to be able to dodge the US regulators. And then they stuffed this conservative insurance portfolio with toxic waste, all the AI capex of the past few years. Another good chart I found to show you how bad it is in the tech sector and AI capex is this chart, basically, which, as you can see, it goes back to 2005. But other than recently, it has never happened that a CIO was telling their CEO to stop investing in capex, like basically saying it's too much. When you get to that point, like it tells you how bad it gets. And when the whole thing unfolds, I think it's going to be like biblical. And here's another very interesting chart that I found. The green is the good portion of the sales. This is basically the real sales, the sales to people paying a market price for it. And as you can see, that part has shrunk massively recently. And basically, most of the rest is just people selling things to each other or selling it to themselves to keep the illusion of the value of the funds that they have. And so this is really bad because it maintains an illusion that something is worth something. But more and more what we are seeing is what you can see here. Even the big players like BlackRock, they slash funds from 100% to zero within 90 days. This is the kind of thing that I think we'll see more and more. And it will probably make 2008 look like a walk in the park. I'm sure you also saw that when their funds don't go to zero, people are still trying to get their money back. But basically, for the first time in their history, BlackRock had to halt withdrawals. So basically, all the people who wanted to get their money back couldn't get it. So this is not going to go well because this is the kind of thing that starts panic. And when the panic starts, everybody rush for the exit. Everybody sells everything that they can sell. And so it can really impact a global market, not just those funds. Another one was the Blackstone BCRED that was hit with 7.9% of the fund people were asking for redemptions. It was much more than they were anticipated. And this is probably just the beginning. So how is the stock market reacting to a global energy shock, a labor market collapse, and a shadow banking crisis? Retail is buying the dip. As you can see on this chart, retail equity purchased on down day are running at the highest level on record, over 100% higher than during the 2021 meme stock frenzy. Like retail is essentially providing exit liquidity for the institutions who are quietly rushing for the door. And on the surface, the S&P volatility looks completely compressed since the beginning of the year. It looks like it's within a tight range, and so you would think that the 500 stocks within it would be mostly doing the same thing, but it's actually the opposite. It's only about one stock out of five that's actually behaving in like the global index, so within plus or minus 5%. All the other stocks are having big swings either up or down, and 101 stocks of the 500 stocks are actually moved by plus or minus 20%. So it's showing you how there's a massive violent sector rotation as the stock market dumps expensive software and tech to buy other assets for defensive or value, or moving to cash equivalent like short-term T-bills. The technical dams are actually breaking if you look at the chart and the moving average that many investors and automated funds use to sell. And the SP 500 has not just closed below the 20-day and the 50-day moving average, which are the first indicators, but has closed below the 100-day moving average or the 20-week. It's basically the same thing. And the last time we saw a breakdown like this, it led to an 80% dump in the bear market. As you can see, most of the time when there's a cross below, it becomes red, and then it stays red either for a long time during a bear market or for a few weeks or a few months during even a V-shaped recovery. So either way, this is not a good news when this is breaking like this. And something I also saw today, I don't know if you know Eddie, but basically he's one of the most famous permeable in the financial markets. And it looks like he just threw the towel. He slashed his odds of a market melt up from 20% to 5%. And he raised the probability of a stock market meltdown from 20% to 35%. The absolute goal right now is strategy before a crash beats panic during a crash. So basically, prepare what you want to do outside of the market opening hours. Otherwise, it can be overwhelming if you're looking at a chart and it goes up or it goes down very quickly and you get headlines on CNBC. And then you could get the opposite 5 minutes from now. Like we saw today, there was a tweet saying a US ship was able to escort another ship through the Strait of Hormuz. And then the tweet was deleted. And so you saw oil crash down, then go back up very quickly. So this is the kind of stuff that can happen. This is basically a headline-driven market at this point. There is no more fundamentals. Consider cash as a position. It's not the absence of a position, despite what some people might tell you. Of course, it's not financial advice. Do what is best for you. So the rotation out of digital financialization and into real-world commodities, energy and defense, is likely a multi-year thesis. So if you are making directional bet on volatile assets like oil right now, naked positions are incredibly dangerous due to the headline risk. And so, for example, if a macro trader wants to participate in another melt up on oil, they are forced to use vertical trade to reduce the risk. In simple terms, instead of risking, for example, $1,000 on oil going over 120 to 150, for example, well, the option spread could actually reduce that risk to $400 instead of 1,000, and the gain would still be 3,000. So that's like a risk reward of about 7.5. So that's pretty good because usually with the volatility, you might be able to get a 2 to 3 risk ratio reward. So this is how the institution and the hedge fund usually define the risk. For hedging, so basically buying a put option near the current price, is becoming very expensive because of volatility. So what institutions often do is they use collars to finance the downside protection, basically selling a call option higher than the current price or at the current price. Another thing I wanted to quickly mention is that doomsday insurance, basically like a minus 50% or something like that, they remain relatively cheap. They haven't moved that much. So if that's something that interests you, that's something you could look into. And finally, a quick note on Bitcoin. It's interesting to see that it has held up incredibly well as a neutral asset with everything that's been going on in the past 2 weeks. However, if the traditional market breaks, be prepared for the potential of a severe flash crash. So the data and frequency of those Six Sigma events that are telling us that the nothing ever happens complacency era is over. So stay vigilant, look beneath the surface, and don't get caught being the exit liquidity for institutional investors. I hope this video helped you. Feel free to give me a comment or a question, and I'll do my best to answer. Thank you.